This is Alan Bush with ADMIS with the daily financial forecast for Thursday, December 17th. Starting out with the stock index futures, we did see good gains yesterday afternoon, even though the Fed did raise interest rates by 25 basis points to a new level now of 25 to 50 basis points. This move from the Fed was widely anticipated, and it looks like the rally that we did see yesterday in the indices was somewhat of a relief rally since the rate increase was so widely expected by so many analysts. Also, we are seeing some follow-through gains today. Historically, the month of December usually is a strong month for global stock index futures, and I think we will see a strong finish to the month. Even though futures now a little bit lower, I think we can see it move back to at least higher on the day, and of course higher longer term. In fact, we do believe that we will see new historical highs in all of the major indices next year. Now, moving over to the currencies, now that Asian and European traders have had a chance to look at the Fed rate increase, the dollar substantially higher in the overnight trade. Other major currencies substantially lower as a direct result of the Fed raising rates yesterday. We also are seeing some additional pressure coming into the euro currency after an index of German business confidence coming in on the weak side and the pound lower, even though we did have retail sales in the UK coming in stronger than expected. So it's the rate increase yesterday that is dominating currency fluctuations yesterday and also into today's trade. Now, moving over to the interest rate futures markets, the 30-year bonds putting in a good performance yesterday, even though the Fed did raise rates, and futures are higher also at the long end of the curve. We do feel, though, that core inflation rates around the world are starting to show an increase, and I think that will be a limiting factor to the upside for the long end of the curve, especially the 30-year bonds. Also, it does look like we will see another rate increase from the Fed, probably at the March meeting. At least that's the consensus view. Also, according to the Fed statement, they are expecting to raise rates 4 more times next year. This contrasts to a survey of economists which believe that the Fed will raise 3 times next year, and our own analysis suggesting that we will probably only see 2 rate increases next year. So in any event, with core inflation starting to move up, as we mentioned, I think that the 30-year bonds are likely to head lower longer term, and I think this is a trend that will persist for quite some time, but it's mainly for the long end, the 30-year bonds, that we are turning more bearish on. So good trading, everyone, and once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
So